Hi traders, Matt bringing you today's lesson, which is going to be on volatility. Now in recent times, in early 2018 at the time of recording, we'd just seen the markets pull back by 10%. So this is a real topical approach to analytics, which I think will give you a great deal of insight into how professionals tend to approach one aspect of the analysis process. So what we're going to cover today is what is volatility. I'm going to discuss the investor fear gauge. This will be a great one for those who are relatively new to the markets. We're going to take a look at different market conditions and how the investor fear gauge reacts to that. And then I'm going to offer you some practical use for strategy, either using volatility or for actually trading the volatility index. So let's take a look at volatility. What is it? Well, basically the definition is the liability to change rapidly and unpredictably, especially for the worse. So volatility is something where when we have a great deal of volatility, we're typically fearful of what's going on in the market. So volatility is usually associated with risk. So the higher the volatility, the higher the risk. It's also considered to be uncertainty in the market. So if we have too much volatility, then there's uncertainty. Most people are longer term investors. They're not shorter term traders. If you're a longer term investor, you want a great return, but you don't want any volatility to go along with that. And this is where it's a double-edged sword. To get a great return, or to higher the return that you're looking for, the higher the risk that you have to implement. And therefore, the higher the risk, the more the volatility. But volatility can provide us with a great insight into investor sentiment, as long as you know how to read it and what you're looking at. So what I'm going to do now is I'm going to jump into our trading platform and take a look at volatility. Okay, so I have the S&P 500 index chart up in front of us here. So to give us a little bit of a background so that I can build up to volatility. First of all, this is my standard trading template. However, with the S&P 500 index, it represents the top 500 shares by market capitalization or valuation in the US markets. Now, the S&P 500, just as we can see here on the right-hand side of the screen, has retraced about 10% from its high to low. Well, not quite, a little bit further than 10% down to its low a couple of days ago, but is now down at its 100-period moving average. Now, that represents the broader market. Now, some of you may have picked up that on my screen, I actually have a chart here which is volatility. Now, this isn't particularly the volatility that I'm going to be discussing today. That's actually option implied volatility for the S&P 500. Now, that is something that's a little bit beyond today's lesson, but I will have another lesson on that one very soon. What I'm going to do is I'm going to change this to the volatility index. Now, the VIX, or volatility index, is also referred to as the investor fear gauge. Now, basically, what this does is it is a reading of the investor sentiment, whether they're confident or uncertain about what's going on in the markets. So before we take a look at this spike up in the VIX here, just in more recent times, what I want to do is I want to take a look at the last several months. Basically, that's a year on the VIX index. Now, what we can see here is a sideways moving market. Now, if you take a look at the time frame at the bottom left, we're talking February, March of 2017, all the way through to January 2018. And during that time frame, there was a solid base in around 9 points. It would spike up into that 13-point range, and in a couple of instances, all the way up to 16 points. This is the normal behavior for the volatility index during a bull market. So as the markets are broadly going upwards, stock prices are rising, the volatility index is basically just traveling along sideways. Now, no market tends to just go up consistently. There will be periods where it'll go up for several days, it might pull back for a day or two, it'll go up again and pull back a little bit, but broadly the trend is going up. And so these little spikes in the VIX represent those periods where the broader S&P 500 market has pulled back slightly. So that is a bull market. So this is one of the approaches that we use the VIX for, is to identify whether or not the shorter term pullback that is occurring in the broader market has got any real investor sentiment picking up behind it. Now, if we scroll through, and I'm going to have to zoom in a little closer here to the market behavior just recently, we can see the VIX has gone out of that sideways range that we were looking at, and it's popped all the way up, even peaking at 50 points there on the 6th of February. And since then, it's really been hovering above 25 to 40 points. Now, that coincides with that 10% decline in the S&P 500 index. So we can see that the VIX has started to break out of that 15-point range and has pushed higher. And compare that with the S&P 500 index that we just had a look at, and you can see the broader upwards trend in place, and then, of course, the correction or the pullback in the broader markets. So as the VIX started to break away from its upper range, the 15-point range, and into this new region here, that is the insight that it is providing us, that the investor sentiment is really starting to change. So to give you an idea, and I'll take a moment just to scroll back. I might even just edit this so you don't have to sit here and watch me doing this through the video. Here we have the long-term chart of the VIX. Now, this is on the right-hand side is the more current activity. You can see that particular spike, which we are looking at monthly candlesticks here. So each candlestick represents 1 month compared to the daily review we were doing earlier. And there have been a couple of points where it has spiked up into that 40 to 50 point range. But look at since this bull market has been in place, it has only occurred 4 times. And none of those times actually resulted in a big bear market coming into play. However, the GFC, October of 2008, we can see that the VIX spiked all the way up to 90.3 points just in through that high there. And at that point in time, the VIX had already been shifting higher. So there was a bit of insight into that. We were already in a bear market from mid-2007. And so that was a very different dynamic to the environment we've had for the last couple of years. So the VIX is a little bit of insight into investor sentiment. And that is the key to it. It is not a predictive methodology, but it is certainly one that overlays with our technical analysis of the broader trend, our fundamental analysis, and our economic analysis. We add all of those together and we're painting a broader picture or a bigger picture of what is going on in the environment that we're dealing with. That can influence our strategy decisions, or whether we add new positions into our trading, or whether we are just tightening up our exit approach on existing positions. So for reading the VIX, there's a few key tips for trading decisions that I'd like to offer you. First of all, where is the VIX with regards to the trend of the S&P 500 index? As we were looking just before, right up until mid-January, at the time of recording there, the VIX had been traveling along in a range between 9 points and 15 points. As it started to push the upper boundaries of that 15-point range, with the markets in an overbought environment, the S&P 500 index in an overbought environment, that started to offer a scenario of, okay, well, there's a bit of investor fear up at these heights, so maybe there is a reasonable expectation that the markets could pull back to their average. So notice I wasn't talking about, it's going to be a big crash, or the markets are going to turn into the biggest bear market that we've ever seen. No, what I'm talking about is that the current bull market is a little bit overbought. Investors have been a little bit too enthusiastic to drive these prices higher, and the VIX is now starting to show a little bit of uncertainty. So we can then implement some strategy around that. Second of all, if the VIX breaks through that upper range of the S&P 500 while the trend is still pushing higher on the S&P 500, then consider this a warning signal, okay? I was just discussing that. I kind of merged those two together. Now, a rising VIX, if the VIX has gone up for the day and the S&P 500 has gone up for the day, that to me is a little bit of a warning signal that maybe there's a little bit of uncertainty. It could be ahead of some economic news, so you can go and check that. It could be during earnings season, for example. So then it's just an opportunity for you to potentially be aware that the markets might pull back for a couple of days. It's not a given. It's just one of those little red flags that pops up that you then use as part of your decision-making process on a day-to-day basis. Now, don't chase the VIX. If the VIX has popped over, say 15, 16 points, or is up over 20 points, you've missed the boat. So you don't chase the VIX once it's already started to move. You're using it as an analytical approach to then evaluate whether or not there's opportunity there that the markets might pull back in the decisions you make with your other positions. And finally, I never short the VIX. Okay, that is a low probability play. So if the VIX is popped higher, it's popped higher for a reason. There's been something in the markets that has caused the VIX to break that range that it normally has during a bull market, and that means that there's uncertainty, there's investor fear out there. So I never short the VIX, because if it's popped up, and let's say it's at around 35 or even 40 points, now it is most likely that when things settle, as long as your economic and fundamental analysis in behind hasn't really changed too much, the VIX is going to settle back down to its range at some point, probably not too far away. But if there's been a reason for it to pop higher, that's not to say that the VIX won't, in its own volatility, fluctuate a lot and even pop up to 50 points. So I never short the VIX, because the risk is that it could pop higher to 50 points, 100 points, as we saw during the GFC. So that's just a low probability play. Actually, what I will do is I will go back into our trading platform, and I'm just going to pop the VIX back onto a daily chart, because what I want to do is show you one of the trading plays that you can implement whilst you've got a clear bull market in place. So we can see here from early 2017, the VIX was really running along. Earlier it had been on a base of 10 points. It then started to pop down towards 9 points, and any little pullback in the markets would send the VIX up to, say, 13 points, maybe 14 points, sometimes up to 16 or 17 if that market had a little bit more of a pullback. So here is the play. Here's a strategy play with the VIX. Now, this isn't for beginners. This is something that's a little bit more advanced for traders that are familiar with options or familiar with trading and have a strategy plan in place. So normally what I might do is I might have a very small position, so a lot smaller than my normal trade packet size, where if I believe that the broader market is overbought, and that's the S&P 500 index. So like it was recently, it was several percent above its medium-term moving average, the 50-day moving average. The expectation is that that will revert back to the mean at some point. It could continue to go up a little bit higher, but the faster a market moves higher, or the sharper the trend upwards, the more likely you will revert back to the mean sooner rather than later. So as the VIX starts to pop down because the market's going higher and is down around that 10-point range or even lower, I'll go and buy what I refer to as a sleeper position. Something that's really small. It's not a big impact on my account. If it was a 100% loss on that little trade, it's not going to impact what I'm doing overall. But it will give me an opportunity that if the VIX pops higher, then I can make a little bit of a trade out of that. So normally what I'll do, and you can't buy the VIX index itself, so I need to use something else to do so. I use call options in this scenario. I look for a medium to longer term dated call option, anything that's 4 months, maybe 6 months out, and I will look to buy a slightly out of the money call option, usually something maybe that's 1 or 2 strikes, 3 to 4 strikes on the outside, higher than where we're at, something that is achievable. If the market can get up to this 11 points here, I might be looking at the 11-point strike on the call options 4 to 6 months out. Now, the reason why it's a bit more of an advanced type approach is that the dynamics of options on the VIX are very different to your normal stock dynamics. You really do need to understand the time decay involvement, the delta of those options, and the volatility of those options is usually a lot higher in the VIX than it is with a normal stock. So with that, I will normally try to buy a longer dated call option, and depending on how the market's progressing, I might make it a cheaper trade. If we start to get a little bit of a push higher, I might sell an out of the money call option for the same expiry month, therefore creating what's called a debit call spread, which reduces my costs but also allows me to make a reasonable profit out of that trade. And that way I'm going to be selling a call option that is where I think is an achievable target level there. If the VIX happens to pop higher than your sold call option strike of the debit spread, you've got bigger things to worry about, because it typically means that the markets are pulling back a little more than you might have anticipated based on the underlying S&P 500 and the VIX itself. And so if you happen to get out of a trade, say up in through this range here, you're out of that trade, the VIX pops back down, you might look to re-enter a few weeks later. You have a sleeper position again lying in there, and of course as the VIX starts to pop higher, you again make a little bit of a profit. At this point in time, you might not be thinking the markets are going to break higher, but as that starts to push higher, it's like, okay, there we go. The VIX has now shown that there's a lot of uncertainty amongst investors, or there's a lot of fear amongst investors. So as always, with your strategy, choose an approach that suits your broader plan of how you're managing your trading. If adding a trading approach with the VIX, like I just discussed, suits your other trading activity, then add that in as part of that strategy approach. This lesson is all about analysis. Identify the conditions required for the strategy. So remember, the VIX, it derives from the S&P 500. So you use those two in conjunction. You're looking to use the VIX as a means to identify if investors are getting a little bit fearful about what's going on in the markets. And as always, with your management, stick to your rules for portfolio and position management. Don't overcapitalize on individual trades, because that one day where you put more than you normally put down on a trade will result in a bigger loss. And it's just Murphy's Law. I'd like to thank you for attending today's lesson on volatility in the markets. If you've got any questions, please feel free to email me on coach@matthewbrownmentoring.com.